Okay, hello, good afternoon, and welcome to this afternoon's class. As I've always done, please, if you can hear me, raise your hand up. If you can hear me, raise your hand up. Okay, so I can see about 21 hands up. I assume that the rest can hear me. Okay, so let's proceed. So sorry about Tuesday. My internet was messing up. I had connectivity issues, so I couldn't log on. And that is why the class could not come on. So what I'm going to do is today, I don't know your schedule unless you have another class after 2:10. I would want us to continue for an hour more, so that we'll be able to complete the content on production and cost. So if the class rep is here, I would like to know from you if you have another class after 2. So if you can raise your hand up and then I can unmute you so you give me an answer to the question. So if the class rep is here, or if the class rep is not here, and any person can provide an answer to the question, I would be glad to allow the person to do so. Okay, so all right. So it looks like you have a class from 2:30. All right, then that means that we will not be able to continue till about 3. That's okay. I would have to find an extra time to do whatever is left. And then next week too. So please, by the way, although this week is the last week of lectures, as you are aware, we have not completed the content. So we still have market structures to go. And if I get 3 more meetings with you next week, I should be able to complete that. So although next week is a revision week, I would still have 1 week of classes. And of course, the reason why that is the case is because we did not start the first week, right? So please make sure you attend next week's classes as well. Okay. Okay. So the content for today is production and cost, right? And it's going to be split into 2. So I would finish production today and maybe possibly start with some aspect of cost and then complete it the next time we meet, probably tomorrow or Sunday. Right. So by the end of these discussions with regards to production, these are the things that I expect you to be able to do. One is for you to explain what production is and also what a production function is. And 2, for you to be able to explain the main factors of production and then the role of the firm in production or in the production processes. 3, for you to provide an economic view of the difference between long run and short run periods in production. And then explain the relationship between total, average, and marginal fiscal products for short run and also long run production periods. And 5, for you to explain the law of diminishing marginal returns and also returns to scale. So these are phenomena that happen in the short run and the long run respectively. So you need to explain what these things are. And then the next one is to distinguish between economies of scale and diseconomies of scale. And lastly, for you to be able to explain the concept of isoquants and then the marginal rate of technical substitution, which is the slope of the isoquant. So these are the things that I expect you to be able to do under production. So once we are done with production, you should be able to provide questions or answers to questions relating to these areas. Right. So let's start with production. So when we say production, what do we mean? So all the goods and services we see out in the market goes through a production process. So if you buy water, for instance, it has gone through a production process. If you buy a food, it goes through a production process. So any commodity that you buy out there or a service that you seek for out there goes through a production process before the commodity is sent or brought to the market. So what therefore is production? So production is basically an activity or the process of combining inputs to produce the commodities that you see out there. So if you pick a bottle of pure water, Baltic water, for instance, an activity or a process went on before the bottle came out as it is. And that process is the production process, and that involves the combination of inputs. The inputs will include the raw materials, the water itself, the labor, the capital, the machines, the cars, the land, and all other inputs that are combined or put together to produce the Baltic bottled water that you see out there. So that's basically what the production is, right? So it's a process of combining inputs to produce an output. Okay, now why do firms engage in production? So the main objective for production is to sell the outcomes and then maximize profits or achieve the maximum profit that there is to be achieved, right? So you engage in production to achieve or to maximize your profit, and therefore you would have to find efficient means or ways of producing output in order to achieve your maximum profit. So what therefore are the inputs of production? So the inputs are basically the resources, that are used in the production processes. Now, in terms of inputs, we have the traditional inputs or factors of production, and these are capital, land, labor, and then entrepreneurship. So these are broad categories of inputs, right? So if you look at the production process for each firm, any input that is used by the firm can be classified under each or under one of these broad categories of inputs. So the firm combines these inputs to produce the outputs, and that is what is a process of production. Right? So that's basically what production is. So if you look at what we are doing now, even in terms of your university education at the moment, we are going through a production process. So the University of Ghana is combining inputs, which includes myself. I'm part of the labor inputs. The buildings that you attend lectures in, the buildings that you sleep in, the staff that assist you at the city campus when you have issues, and all other things that are done to ensure that you graduate successfully in 4 years' time. So our final product is a graduate, right? So you are going through a production process so that at the end of 4 years, a graduate is produced. Okay, so that's basically what the production process is. Now, when it comes to the inputs of production or the factors of production, we can classify or we can distinguish between a fixed input and then also a variable input. Now, a fixed input is an input that does not change or whose quantity does not change as output of the firm changes during a given period of time. Right? So within that period of time, that input cannot be changed. In other words, the quantities of that input cannot be varied. It can be changed. That input is said to be a fixed input within that given period of time. And then a variable input is an input that quantity changes as output change during a given period of time. So for a variable input within that given period of time, if you want to produce more output, you employ more of that variable input to produce more output within that given period of time, right? So in other words, what we are saying is that a fixed input is an input whose quantity cannot readily be changed, right, within a specified period of time. Whilst the variable input, you can change it within that period of time. So please note these two types of input, a fixed input and then a variable input. A fixed input, you cannot change the quantities as output changes within the given period of time. But a variable input, you can change its quantity as out. In fact, the quantity changes as output changes within the given period of time. So an example of a fixed input in most of the examples that we are going to be using is land, for instance. So if you pick a farmer, maybe within 1 month or 2 months or 3 months, land might be a fixed input to that farmer because he cannot acquire a land within a month or two. Sometimes factory space can also be a fixed input within a specified period of time. Plant and equipment, yeah, acquiring equipment and plants might take some time. So within a some period, we can't easily change or add to our plants and equipment. And then the variable inputs, labor in most cases is referred to as a variable input, and also the raw materials that are used in producing a particular commo- a particular commodity is also referred to as a variable factor. So given our explanation of what a fixed input is and what a variable input is, what therefore is a production function? So we know what a production is. So combining inputs to produce output. So what is a production function? It's just a mathematical expression of the relationship between inputs and then outputs. So how many units of output would you be able to produce when you combine certain quantities of inputs? So the mathematical expression of that relationship is what is referred to as a production function. So a production function describes the relationship between a flow of inputs and the resulting flow of output in the production process during a given period of time. So there's an equation you see on your right. That equation is what is referred to as a production function. So it's saying that output, which is represented by Q, is a function of L, which is the units of labor, K is the quantities of capital, and then M is the quantity of material inputs. Now, in addition to these three factors of production, there could be other factors of production. Technology can be one of them. and then all other factors that can be used to produce the output goes into the production function, right? So this is a general production function that specifies the relationship between output and the inputs used in the production process. Now, to discuss production, there's a need for us to distinguish between two periods of production. There is a short run period of production and then the long run period of production, right? And therefore, the analysis on production would be broken into these two periods, the short run period and then the long run period, right? So therefore, what is a short run period? Now, a short run period for a firm is a period in which at least one input or factor of production cannot be varied or it is fixed. So the short run period for a firm is a period in which at least one input or factor of production is fixed. So it means that for that particular period, the firm has at least one input of production that remains the same and cannot be varied within that period. That is what is referred to as a short run period for a particular firm. Now, in addition to that, we have a long run period. The long run period is a period in which all factors of production can be varied. So it's a period in which all factors of production can be varied. So there are no fixed input within that period. Right? There are no fixed input within that period. All the factors of production can be varied. Now, what I want you to note here is that the short run and long run period differ from firms to firms, right? So there is no general period that everybody or all firms have as short run and all firms have as long run. The periods differ from firm to firm. It is firm specific. One firm's long run period might be another firm's short run period, and another firm's short run period might be another firm's long run period. So these periods differ from firm to firm. There are no specific or general long run and short run periods for all firms in a particular industry or in a particular country. So they differ from firm to firm. Okay, so somebody is asking if there is an introduction to technology. Yes, if there is technology, in most cases we use the letter A, capital A, to represent technology. So if there is technology, you will see that it's also specified in the model. Okay, so please take note of that. The fact that the short run and long run periods are specific for a firm. So they differ from one firm to another firm. They are not the same for all firms. Please take note of that. Okay. So now we want to do an analysis of the short run period. That's the production process for the short run period, right? And to do that, we are assuming that the firm uses only two inputs of production. And these inputs are capital and labor. So the production function for this firm would have only capital and labor in it as the inputs of production. And then we also assume that the fixed input here is capital. So for this firm, the fixed input is capital. So capital cannot be varied within that period that we are looking at. And the variable input here is labor. So labor can be varied within the given period of time. So it means that for this firm, if the firm wants to increase output, it only has to increase labor. It cannot increase capital because capital is fixed. So if the firm wants to produce more, it has to hire more labor. And to produce less, you have to hire less labor or reduce the number of labor that you already have. Right? So this means that in the short run, what changes output or what varies output is the variable input in the short run. So the fixed input do not change output because it is fixed. So what can increase output is a variable input. So that's the point I'm making here, that to increase output in the short run, a firm must increase the quantity of labor it uses based on these assumptions that we have made, where we have only two inputs, capital and labor. Capital is a fixed input and labor is a variable input. And therefore, if you want to increase output in the short run, you can do so by increasing the quantities of labor employed. So given this assumption, we can distinguish between three measures of productivity in the short run. And these are: one, the total product of labor. And I'm adding labor because it is labor that we can vary to increase output in the short run. So we have what we call the total product of labor. We also have what we call the marginal product of labor. And then we also have the average product of labor. So these are the three measures of productivity that we have in the short run that we want, or I want us to look at. So we'll first of all start with the total product of labor. What is it? So the total product of labor is basically the total amount of output produced with given quantities of the fixed inputs and then the variable inputs, right? So for instance, you see a production function on the right side of your screen. So the Q is actually the total product of labor. So given a specific quantity of K, which cannot be varied, but we can vary the quantities of L. So any quantity of L would give us a particular quantity of Q. And that quantity of Q is what we refer to as the total product of labor. Now it is total product of labor because it is labor that can be varied. Assuming it was the reverse, where labor cannot be varied but capital can be varied, then it would have been the total product of capital, right? But because capital is fixed and it is labor that can be varied, then we have the total product of labor. So it's basically the quantity of inputs that you produce with a given quantity of the fixed and the variable inputs, right? Now we will see that as we employ more units of labor, the total product would rise. That is, the total product of the firm is going to rise. It will reach a maximum and then will start falling if we continue to employ more units of labor. And that is explained by a particular law that I will explain later on. Now, in addition to the total product of labor, we also have the average product of labor, which is one measure or another measure of productivity in the short run. The average product of labor. Right now, this is basically the quantity of output per unit of the variable input. Right, quantity of output per unit of the variable input. So we are looking at averagely how many units does a unit of the variable input produces, and that is what is referred to as the average product of labor. Now, mathematically, it's obtained by the formula you see on the left of your screen, which is the total product divided by the units of the variable input employed. So since the variable input here is labor, that is why we call it the average product of labor. If the variable input were to be capital, then we would have the average product of capital, right? So in this case, it's labor. Therefore, we call it the average product of labor, APL, which is equal to the total product of labor divided by the units of labor employed. And that will give you the average product of labor. There's a table in the subsequent slides where we are asked to calculate them. Therefore, I will explain that further when we get there. Now, the next measure of productivity is the marginal product of labor. The marginal product of labor. Now, this is a change. Marginal product of labor is the change in your total product as a result of employing an additional unit of labor. So, given our understanding of economics so far, we've been talking about marginal for a while now. So I believe with the hearing of the word marginal, it gives you some idea of what it is. So here, if you change your labor input, your output is going to change. So how much does your output changes by a unit change in your labor input? And that is what is referred to as the marginal product of labor. Again, we are calling it marginal product of labor because the variable input here is labor. If the variable input were to be capital, then it would have been marginal product of capital. Right. So how do you obtain it? Mathematically, it is equal to the change in total product divided by the change in the variable input, which in this case is labor. So divided by the change in the units of labor employed. So marginal product of labor, MPL, is equal to change in TPL divided by change in L, or change in Q. Q also represents output divided by change in L, and that will give you the marginal product of labor. So this is a table that I was talking about to help you calculate these measures of productivity. So the first column of the table has the inputs of capital. So once you see that it is constant, it indicates that capital is the fixed input. Right? Once it is constant, it indicates that capital is a fixed input. And then you have the inputs for labor. So you see that labor varies. So if we do not produce anything, we don't employ any units of labor. So you see that the first unit of labor employed is 0. And then we employed 1, we employed 2, we add 1 to make it 3, we add 1 to make it 4, up to the 7th unit of labor employed. Now the third column gives you the total product of labor, or the output obtained by employing these units of labor. So you see that in the third column. Now the fourth and the fifth column is for the average product and also the marginal product of labor. So the average product would be calculated for each level of labor employed. So if you pick the first row, the average product would be 0 because it's going to be your total product divided by your units of labor employed. So it is going to be 0 over 0. Then when you get to the second row, your total product is 30. And if you divide that by the units of labor employed, you have 1. And therefore, that will be 30 over 1. That gives you 30. And then you can go on. If you go to the third row, your total product is 70. And if you divide that by the units of labor employed, which is 2, and that will give you 35. And then you can go on to obtain all the average products of labor for each unit of or each level of labor employed. And then you come to the marginal product. So like I said, marginal product is the difference between your total product or the change in your total product as a result of a unit change in your variable input employed. So if you look at the first row, you don't expect to see anything for marginal product. So you put a dash there. Now let's go to the second row. We employed 1 unit of labor. So moving from 0 to 1, that gives you an additional unit there. So initially it was 0 and then you increase it to 1. So the addition is 1. And then what is the additions to your total product? Your total product was 0. By employing 1, where you added 1, in this case, you have 30. So it means that your marginal product of labor for the second row is going to be 30. And then you now move on. So when we move from 1 to 2, we employed 1 additional person. How much did total product increase by? Total product increased by 40. So that will give you the marginal product when we employ 2 units of labor. You can move on to the third one. So by adding another 1 to make it 3, we added about 50 to our total product, and that will give you the marginal product. So you can do this for all the levels of labor employed, and that will give you the marginal product for each of the level of labor. Right. So please take note of this kind of tables. You might have them in exams, and then you are asked to fill the empty boxes, or it could even be in a multiple choice questions where you have a table and then you are asked to provide the value for a particular cell in the box. So please take note of these calculations and how you can move to, or how you can move up and down when you have the down one or when you have the up one with some other values provided for you. Now, if you draw the graph of the total product in the table that we have in the previous slide, the graph will come out as what you see on your screen. So what do you see about the graph? You see that the total product curve rises, at lower levels of labor. And then if you continue to employ more labor, it would come to a maximum. It doesn't rise again. That is where it has hit the maximum. And if you continue to employ more labor, you'll see that it will start declining. So that is the shape of the total product curve. And that shape is as a result of a particular law that I will explain shortly. So you see that at lower levels of your labor units. As you continue to increase labor, your total product curve rises. It continues to rise, it will hit a maximum, and then it will start falling if you continue to increase the units of labor employed. Then the second graph are the graphs for the average product and also the marginal product. They are also inverted U, so they have these shapes, and that look like an inverted U. So if you try to describe them, you also see that for the marginal product, at lower levels of labor, marginal product rises. It will also hit a maximum and then it doesn't rise anymore. And therefore, if you continue to increase your labor, it falls. In fact, it can continue to fall, get to zero, and it can even go into the negatives. And then we also have the average product of labor. Now, what do you see with the average product of labor? That too, you see that at lower levels of labor, it rises, it also hits a maximum, and then will start falling if you continue to employ more units of labor. So this is what we call an inverted U shapes, right? They are an inverted U shape. Now, what explains these shapes or the shapes of the total product curve, the average product curve, and the marginal product curve? What explains them? Now, what explains this shape is the law of diminishing marginal returns. The law of diminishing marginal returns. We had a similar law when we studied consumer behavior, where we had the law of diminishing marginal utility. So it is similar to that law, but in this case, it is in reference to production. And the outcome here is output, not satisfaction as in the case of utility. So there's a law of diminishing marginal returns. Now, what does this law say? It says that as you continue to add more of a variable input to a fixed input in the short run, your total output rises, reach a maximum, and then it starts falling. In other words, what we are saying is that as you continue to add more of a fixed input, more of a variable input to a fixed input, your marginal product rises, reach a maximum, and that starts falling, right? And this law is so practical that you observe it, particularly in a case where you have a fixed input or an input that you cannot vary. And then you continue to add more of a variable input to that fixed input. Let's take a farmer, for example, who has 3 acres of land to cultivate maize. And in the short run, the farmer cannot vary the quantities of maize, the quantity of land. Neither can he add more fertilizer. He cannot improve the conditions of the land. He can't do anything to the land, right? So he only has 3 acres of land, and he's going to employ people to work on the land. You will see that as he start employing people, the productivity of the land or the farm will increase. So if assuming that if he was working with one person and he was getting a bag of maize, if he starts with 2, he might get 2 or 3 bags, and then so forth, so forth, so forth. Now, if he continues to employ more people to work on the land, it will get to a point that inefficiencies will set in. Note that we cannot vary the size of the land. Neither can we change the nutrient or any other thing on the land. So if he continues to do that, inefficiency will set in, where workers come to the land to come and work, and they expect that this person, because we are many, you are expected to do this, and then you don't do it. Some would also start free riding and all that, and that will start reducing the productivity of the land or the yield that you get from the land. So that you see that anytime you add more to the number of people working on the land, you are likely to see a reduction in your marginal product. It might even get to a point that where it will be negative and even becomes, we get to a point where it is zero and it even becomes negative. So it means that when you add more, the final output is lower than what it was before. In that sense, you have entered into the negative region of the marginal product of labor. So that's what the law says. So as you continue to add more of a variable input to a fixed input, your total or marginal product rises. They will all hit a maximum at some point, and then they will start declining as you continue to add more of a of a variable input to a fixed input. That is what we mean by the law of diminishing marginal return. Now note that this law happens only in the short run, or the phenomenon of diminishing marginal returns happens only in the short run. It does not happen in the long run. And the reason why it happens in the short run is because there is a fixed input. If we can vary the quantities of land, or if the farmer can vary the quantities of land, then he wouldn't have problems with the law of diminishing marginal returns. So once he has more people on the land now, what he has to do to increase the productivity is to employ more land so that the extra people can get land to work on. But if you cannot vary the quantity of land, that is when you experience the diminishing marginal returns, right? Diminishing marginal returns only happens in the short run. It does not happen in the long run. So please take note of this statement. It's very important. Diminishing marginal returns occurs only in the short run. It does not occur in the long run. Okay. Now we can put these three diagrams together to come up with stages of production. Right. So there is some relationship among the three graphs or curves that can be used to generate the stages of production. So that is what has been done on your screen. So there are three stages of production. There's stage 1, there is stage 2, and then also stage 3. Now, where does stage 1 start and where does it end? So stage 1 starts from when you start employing the units of labor, and then ends at where the marginal product of labor is equal to the average product of labor. And that only happens at the maximum of the average product of labor. So stage 1 starts from when you start employing units of labor, the unit of labor that you start with, whether you start with 1, 2, or 3, and ends at where the average product of labor is equal to the marginal product of labor. And this happens when the average product is at the maximum. That is stage 1. So that is what you see on your screen. This is stage 1 of a production process. And then we have stage 2. Now stage 2 starts from where stage 1 ends. That's it. That is, it starts from where the average product of labor is equal to the marginal product of labor, which occurs at the maximum of the average product, and then ends at the point where the marginal product of labor is equal to 0. At the point where the marginal product of labor is equal to 0. And that happens here. So it starts from here and then ends here. And then, of course, the stage 3 starts from where the marginal product of labor is equal to 0 and then continues up to whichever level of labor that you would employ. So these are the stages of production, right? Now the question is, in which of these stages would this firm produce in the short run? In which of these stages would a firm in the short run produce? Now let's see where it will produce. Now we see that stage 1, or let me say stage 3, is out of the question. The reason is that in stage 3, the marginal product of labor is negative. So it means that the extra unit of labor that the firm adds reduces your total product. So rationally, no firm will produce in stage 3 at all. So that is out of the question. And then therefore we are left with stage 1 and 2. Now let's see stage 1. In stage 1, your marginal product of labor is above your average product of labor in stage 1. In other words, you have a positive, your marginal product of labor increases, and then your average product of labor also increases. You can produce in stage 1, but the question is it optimum? And the answer is no, it is not optimal, because if you continue to add more units of labor, you can make more profit. So therefore, the firm, for rationality or for profit maximization purposes, would not produce in stage 1. So the obvious stage left that a firm can produce in is in stage 2. So in stage 2, you see that both the average product of labor and the marginal product of labor are all falling. So it means that you continue employ labor up to the point where, the marginal product of labor would turn negative. So in between this stage, that is from this point to that point, then you can produce in any point in that range. So the firm rationally produces in stage 2. Now the specific unit of labor that you produce or that you would employ within stage 2 is dependent on your technology and also the input prices that you face as a firm, right? So the input prices you face and then the technology that you also face. But your production would take place within stage 2. So it means that you can employ either 7, which is the boundary of stage 2, or you can employ 10, which is also the other boundary for stage 2. And then you can employ in between. You can have 8 or you can have 9. Now I'm saying that whether the firm will employ 7, will employ 8, will employ 9 or 10 is dependent on the technology that the firm is using and also the input prices. Right? So I will show you the equilibrium condition that this firm would have to fulfill in order to maximize profit in stage 2. So the table you see on your screen is describing the relationship between the 2 or the 3 marginal productivities or the productivity measures that we have talked about: the total product, the average product of labor, and then the marginal product of labor. You have the slides so you can read it. I've already discussed all of them, so you can read it when you get back to your hostels. Now, to summarize the the relationship between the three measures of productivity. So one key relationship that comes out vividly is that when the marginal product of labor is above the average product of labor, the average product of labor rises, right? It is increasing. So anytime the MPL is greater than the APL, then the APL is rising, right? It is rising, and the reason is that the extra quantity gives you, or extra unit of labor employed gives you more to MPL compared to the APL. So that is one relationship. Another one is that there's a point where the MPL is equal to the APL, and that only happens when the APL is at the maximum. So when MPL is equal to APL, then APL is at the maximum. In other words, the MPL curve cuts the APL curve at the maximum of the APL. So that is also another relationship among the three productivity measures. Then there's also another one. When the MPL is less than the APL, then the APL falls or reduces. So when marginal product of labor is lower than the average product of labor, the average product of labor reduces or declines. And that is a third reason. Then there's a fourth one which is not here, but you can note it down. And that is when the marginal product of labor is equal to zero, the total product of labor is at the maximum. So you can note that down. When the marginal product of labor is equal to zero, the total product of labor is at the maximum. So this is what I'm saying. If I go back to the graph, you see that where the marginal product of labor curve cuts the x-axis, you see that the total product has reached a maximum at that point. So please take note of these relationships. There are questions that could be asked in the multiple choice questions, or you could be asked to explain them in future. So this is the diminishing returns that I talked about. So you can, I think I have already described it, and then you can read the notes for further explanations on that as well. So now this is also talking about where exactly the firm will produce in stage 2, or which of the stages will this firm operate in. So I have explained to you that production will not take place in stage 3, obviously, because the marginal product of labor is negative. And again, it will also not take place in stage 1 because the production is, or factors of production are underutilized. You can get more if you employ more units of labor. And of course, the last bit is the stage 2, which is where the firm will produce. And I've explained that to you why that is the case. So now the specific point in stage 2 that this particular firm will produce, like I said, depends on technology and also the input prices. So if the labor, if labor is a variable input, or let me say that the rule is that the firm should employ a particular variable input up to the point where the value of marginal product of that input is equal to the cost of that input. Now this is similar to the rule we have in economics, which is taking decisions at the margin. So in other words, it's just saying that employ labor or capital, assuming capital is a variable input, up to the point where the marginal benefits of capital is equal to the marginal cost of capital. Or if it is labor, employ labor up to the point where the marginal benefit of labor is equal to the marginal cost of labor. So one would ask, what is the marginal cost of capital, or what is the marginal cost of labor? Assuming that capital is a variable input, then the marginal cost of capital will be how much you pay for capital, which in most cases is the interest, so the R. And if it is labor, the marginal cost of labor will be the wage, how much you pay for a unit of labor. Now, how do you find the marginal benefits? So in production, the marginal benefit is the value of the marginal productivity of that particular input. So the marginal product is the units, but how do you value the units? The value of the units becomes the marginal benefit. So to value the value, or to find the value of the units, you multiply the marginal product by the price, and that is what gives us the value of marginal product. So the value of marginal product is equal to the price of the commodity times the marginal product of the inputs. So if it is capital, for instance, which is the variable input, then the firm should employ capital up to the point where the value of marginal product of capital is equal to the marginal cost of capital, which is the rate or the interest rate. And if it is labor, it is employ labor up to the point where the value of marginal product of labor is equal to the wage rate. So the value of marginal product of labor will be equal to the price of the commodity multiplied by the marginal product of labor. So whichever units of labor that ensure that this equation is established, or this equality is established, then that unit of labor should be what the firm should employ. And that is within stage 2. That would happen in stage 2. Good. Now let's look at long run. So what we have done so far is the short run production processes. So now we want to look at long run. Now long run is a little bit complicated because now all the inputs can be varied. There are no fixed input in the long run. So that is a little bit complicated, right? But this is not a mainstream economics class, so we are not going to go into too much detail to specify ISO costs and then some other things that are very similar to what we did for consumer behavior. So we are just going to introduce you to the long run analysis without necessarily going too much into details. So we know that in the long run, all inputs are varied. You can change any of the inputs. You can change the quantity of any of the input. There are no fixed inputs in the long run. Now, if that is the case, then you know that if you want to vary output, you can vary any inputs. So there are no fixed inputs. So all your inputs are variable. So there is no input that you would say that you can't vary it if you want to vary output. You can vary all inputs because they are all variable inputs. So therefore, how do output varies? when you vary inputs. So what is the relationship between changes in inputs and then changes in outputs? In the case of short run, we saw that it is the law of diminishing returns or diminishing returns that explains the relationship between inputs and output. So the diminishing return says that as you vary your inputs, that is a variable input, your output rises, it reaches a maximum, and then it starts falling. Now, if all inputs are variable, then what explains the relationship between inputs and outputs in the long run? And that is what is referred to as the returns to scale. So there's a law of returns to scale, or you can say returns to scale. So returns to scale explains the behavior of output to a change in inputs in the long run. So this is also only a long run phenomenon. It does not happen in the short run. So returns to scale happens in the long run. It does not happen in the short run. Right? So it's explaining the relationship between output and input, or how output respond to a change in input in the long run. Now, output can respond in three ways. So therefore, or as a result, we have three types of returns to scale. So output can respond in three ways, and therefore we have three types of returns to scale. And these are: one, constant returns to scale; two, increasing returns to scale; and three, decreasing returns to scale. So now let's take them one by one and look at what each means. Constant returns to scale. Now with constant returns to scale, it happens when inputs are varied by a certain proportion. Output also varies by the same proportion. So for instance, if the production mix, you vary input by 20%. So you increase your quantities of input by 20%. And your output also increases by 20%. Then your production process is said to be exhibiting constant returns to scale. So input are varied by 20%, output also changes by 20%. You have a constant returns to scale production. For increasing returns to scale, you vary inputs by a certain proportion, but output varies more than that proportion. So for instance, if I increase my input mix by 20% and output increases by 30 or 40%, then my production process is said to be exhibiting increasing returns to scale. And then we have the decreasing returns to scale. So that one, you vary your inputs by a certain proportion, output varies less than that proportion. So you increase output input by 10% and your output increases by less than 10%. So let's say 5% or 7%. So in that sense, your production is said to be exhibiting decreasing returns to scale. The production process is said to be exhibiting a decrease in returns to scale. Right. So please, these are the three forms of returns to scale that I want you to know. And these only happen in the short run. In the long run. It does not happen in the short run. So somebody's asking me to explain constant returns. So I'm saying that for constant returns to scale, if you vary input by 20%, let's say you are increasing labor by 20% and capital also by 20%, output increases by 20%. So if the percentage increase in inputs is the same as the percentage increase in output, then you have a constant returns to scale. If the percentage increase in output is greater than the percentage increase in inputs, then you have increasing returns to scale. If the percentage increase in output is lower than the percentage increase in inputs, then you have decreasing returns to scale. So those are the three returns to scale that I want you to take note of. Now, in addition to returns to scale, there is also some phenomenon in the long run that I want us to look at, and these are economies of scale and diseconomies of scale of production. Now, one would say that economies of scale is kind of related to returns to scale, but they are not the same. Economies of scale is different from returns to scale. They are not the same. Please take note of that. Economies of scale is not the same as returns to scale. They are not the same. Economies of scale has to do with what happens with your production. That is, I mean, what happens with your cost. For instance, maybe your unit cost as you increase production, right? That is what economies of scale is about. It is different from what happens to your overall quantity of output when you vary your inputs. So it's different. So please take note of that. So Judith, yes. So what happens to output is what determines whether the production function is exhibiting increasing returns to scale, decreasing returns to scale, or constant returns to scale. So I have a hand up, Roger Ashon. Let me come to you. Roger, go ahead. You are muted. Roger Ashon, I unmuted you, but your hand is gone down again. Okay. Um, so your hand is gone down. You can raise it again if you still want to ask the question. Okay, so now let's explain what economies of scale is. So economies of scale is basically cost advantages that a firm enjoys as a result of being a big firm. You can put it that way, or doing things in large quantities, right? And we believe that it's only big firms that do things in large quantities. So a firm is said to be enjoying economies of scale when, as it increases its production, the per unit cost of production reduces. Or let's say the average cost of production reduces. Then you are enjoying economies of scale. Now I will use the cost curves to explain this in details when we start with cost. But because I haven't done cost, I don't want to draw any cost curve at this point. But all I want you to understand is that your production process is enjoying economies of scale when, as you increase your output, your average cost reduces or your per unit cost reduces. Then you are enjoying economies of scale. Now it can come from a number of factors or reasons. One of them can be in terms of marketing, some can be in terms of transportation and storages, some can be in terms of labor, and we can even have technical economies and all that. So let me focus on the transportation and storage, for instance. So let's say that I go to buy some raw materials and I need a trailer to convey the raw materials to my site or my production site. Let's say I need to buy 1,000 units of the material and the trailer can take only 1,000 units. If I buy 1,000 units and then the cost, let's say the trailer charges you 2,000 Ghana for 1,000 units, which fill up the trailer. If I buy, let's say 700 units, the 700 units cannot go into smaller cars. I still have to take a trailer. But the trailer will still charge me 2,000 Ghana cedi, although it is not full, because it's going to use the same fuel and nothing and come back. So it's still going to charge you 2,000 Ghana cedi. So compared to somebody who is able to buy 1,000, and you divide the 1,000 or the 2,000 Ghana cedi by 1,000 to calculate the cost, transport cost per unit, compared to somebody who buys 700 and then pays 2,000, compared to find a transport cost per unit for that one as well. You see that the transport cost per unit will be higher for the person who bought 700 compared to somebody who bought 1,000. So that is the economies of scale that you are enjoying there. So you are enjoying a reduced cost because you bought more. So you are enjoying a lower cost per unit because you were able to purchase more of the item. Another example where you can enjoy or that can lead to economies of scale is when you are offered discounts for buying things in bulk, bulk purchases. You are offered discounts, right? So the supplier says that if you buy above 1,000 or you buy 800 and above, I will sell it to you at 10 cedis. But anything lower than 800, it will go for 15 cedis. So for that person who buys more, is likely to or enjoys a lower per unit cost compared to somebody who buys less. So again, you are enjoying economies of scale there. There could also be economies of scale in terms of labor. So if you are employing the person for a number of days, longer days, the person can charge you lower compared to employing him for just a small number of days. So you enjoy economies of scale also there. So it can come from different angles, right? We can have the technical economies. And even with marketing, as for instance, advertising and all that, if you do more adverts, you are charged a lower rate compared to you doing one. Any addition will be at a lower. Some are even for free and all that. So you enjoy a reduction in per unit cost as a result of doing things in large quantities, right? Then there is also the diseconomies of scale. So it's the opposite of the economies of scale. So here, your per unit cost rises as your output rises, right? So in that sense, you'll be enjoying this economies of scale. And of course, that could be as a result of a number of factors. Inefficiencies will set in. You could have technical difficulties and all that. That can lead to diseconomies of scale as well. Okay. Now, how do we express the relationship between inputs and production or output in the long run. So this increasing returns to scale, decreasing returns to scale, and all that we've discussed can be shown using the concept of an isoquant. And this isoquant is very similar to the concept of indifference curve in the case of production. So in the case of production, you had indifference curve. Sorry, in the case of consumer behavior, you had indifference curve. But in the case of production, we have what we call an isoquant. Okay, so what is an isoquant? In simple terms, an isoquant is a curve that shows the combination of inputs that yield the same level of production or output. Right? So to explain this further, let me switch to the whiteboard to explain the concept of an isoquant. So let's say that the inputs that this firm uses again are capital and labor. And note that they are all variable inputs. And then this is the quantity of output that is produced. So assuming that the firm uses 12 units of capital and then 16 units of labor and then produce 300 units, right? There could be different combination of capital and labor which will still result in that 300 units. So I can have 8 and then maybe 18. I can have 10 and then maybe 15. Let's assume they all result in 300 units of output, right? Now a curve that plots this combination of capital and labor, that curve is what is referred to as the isoquant. So how is that curve drawn? So it is drawn similarly in a way that we draw an indifference curve. So you have labor on the vertical axis, sorry, on the horizontal axis, and then you have capital on the vertical axis. So your isoquant is a convex curve, just like the indifference curve, representing units of output that can be produced with, the same unit of output that can be produced with different combinations of capital and labor. So you can pick here combination A and then combination B will yield the same level of output to the production firm or to the firm. So this is what is referred to as an isoquant. Now the isoquant has similar characteristics like the indifference curve. They are everywhere dense, they are convex towards the origin, and all the other characteristics of indifference curve that we discussed. But although here we relate it to production, right? So the few things about isoquant that I want us to learn is the slope of the isoquant. What do we mean by that, or how do you get the slope of the isoquant? So given that we have capital on the vertical axis and labor on the horizontal axis, the slope of this isoquant will be delta K, which is measuring K change in K over change in labor. That will give you the slope of this isoquant because we have K on the vertical axis and then L on the horizontal axis. Now we can show that mathematically this change in K over change in L will be equal to the negative of the marginal product of labor divided by the marginal product of capital, right? So like I said, in the case of consumer behavior where we did not focus so much on the maths, but we can show that the slope of the isoquant is equal to the negative of the marginal product of labor divided by the marginal product of capital. Just as in the case of consumer behavior, which is the negative of the marginal utility of X over the marginal utility of Y. Same thing here, right? And we can prove this mathematically, but I don't want us to go into that for now. Okay. So that gives you the slope of the isoquant. So what is the slope measuring? How much is needed to sacrifice for a unit of labor? You know, how much K do you need to sacrifice for a unit of labor and all that. Now, in addition to the slope, there is also what we call the marginal rate of technical substitution, MRTS, marginal rate of technical substitution. Just as we have the marginal rate of commodity substitution in the case of consumer behavior. So you see that by moving from one point on the isoquant to another point on the isoquant, you would have to sacrifice some units of K to get some units of labor, and will still be able to produce the same quantity of output initially. Now, the rate at which the firm does this substitution is what is referred to as the marginal rate of technical substitution. So we distinguish this marginal rate from that of consumer behavior using technical, and that for consumer behavior is commodity. So the marginal rate of technical substitution is for production, whilst the marginal rate of commodity substitution is for consumer behavior. Now, how do we find the marginal rate of technical substitution? Again, we can show that mathematically the marginal rate of technical substitution is equal to the negative of the slope of the isoquant, right? Just as we had in the case of consumer behavior. So it's equal to the negative of the slope of the isoquant. So this negative will cancel this negative so that the marginal rate of technical substitution would be equal to the marginal product of labor divided by the marginal product of capital. That gives you the marginal rate of technical substitution. Again, I don't want us to worry so much with the mathematics, but it will be good if you have these in mind, that the marginal rate of technical substitution is the ratio of marginal productivities. Just as in the case of consumer behavior, where the marginal rate of commodity substitution was the ratio of marginal utilities. So this is also the ratio of marginal productivities, right? Marginal productivity. Okay. So let me switch back to our lecture slides and then we continue from there. So I've explained this extensively. So I've explained the marginal rate of technical substitution extensively. Okay, so now we have some time. We can start with cost. I still have about 20 or 25 minutes. So we can start with cost. So we know that every production process has or comes with cost. So the final items or goods that you see out there, they are produced with some cost incurred. So the production is one aspect and the cost is another aspect. So when you need to, for you to find the level that will maximize the firm's profit, you need to combine both production and cost. So we have done production now. Let's now look at cost. Right. So the cost is how much is spent on producing the item or the output that you see out there. So how much is spent in terms of the inputs that we purchase and any other thing that is done. As long as we spend money on it, it's included as cost of the what do you call it? It's included as cost of production. So under cost of production, these are the things that I expect you to be able to do. For you to explain the concept of total cost, marginal cost, and average cost. So you see that these are quite similar to the concept of production. So under production, we have total product. So under cost, it is total cost. We have marginal product under production. We have marginal cost under cost, and then also average product under production, and then average cost under cost. So you need to explain what these things are. And then also explain the role of opportunity cost in economic cost. So we have to distinguish between the accountant's profit and then also the economist's profit. So the accountants have a way of measuring cost, and the economists also measure cost differently. So as a result of that, there are differences in the accountant's profit and then the economist's profit. In fact, the accountant profit is always, in most cases, greater than the economist's cost, because the economists include an extra cost item, which is the implicit cost in calculating its cost. And then also analyze the link between a firm's production process and its total cost. So once we are done with production, we will combine production and cost, particularly for the short run, right? And then examine the relationship between short run and long run cost. So let's first of all start with cost in the short run. So our analysis is in the short run, where we have a fixed input and then we have a variable input. So it's a short run. Okay. So when we say cost, like I said, it's all expenditure incurred in producing the item or the final output that you see out there. So they include cost on labor, cost on capital, cost on raw materials, cost on land, interest paid for loans, and any other cost that is incurred in producing the item. Now for the accountant, cost is only those that money are spent or monetary outlay takes place. To the accountant, the cost is what he or she pays money on. That is a cost to accountant. So for instance, if the accountant buys raw materials, that is a cost. Pay labor, that is a cost. But for economists, cost is not only what you pay money on, but they include implicit cost. So for the accountant, cost is only explicit. So the ones that he or she pays money for, that is an explicit cost. But for the accountant, costs of production also include an implicit cost. For example, if someone has a business and invested his or her own money in the business, when an accountant is measuring cost, the accountant do not include any implicit cost. So as long as it's not a monetary outlay, the accountant will not include it as a cost. But the economist will include a cost, which in this case will be what the owner is losing as a result of putting the money in the business. that will be calculated as the cost of doing the business. So for instance, by investing my money in my own business, I am losing the interest that I could have earned if I had deposited the money in an interest earning asset or account. So if I am measuring my cost of business in this case, I am going to include that or what I am losing by putting in the money in the business. The accountant will not include that. So therefore, economists also include opportunity cost, or what we call the implicit cost, in measuring our cost. So for the accountant, the profit for the business is just your sales that you make minus your explicit cost. So that gives you the accountant profit. But for the economist profit is the sales minus the explicit and then the implicit cost, right? So your sales and then your sales minus the explicit and your implicit cost, right? So that will give you your economic profit. So for the economist, his cost or his profit, it is the sales or the revenue that it receives minus your explicit cost and then again minus your implicit cost. So by the virtue of the fact that the economist has an implicit cost here, his profit will be lower than the economist's profit. Sorry, than the accountant's profit. So the accountant's profit does not include implicit cost, but the economist's profit includes implicit cost. So for the economist, the profit will be lower than the accountant's profit. Okay. So given this distinction, what is the cost function? Right? So in general terms, the cost function is just a mathematical expression of the relationship between the firm's cost and the quantities that it produces. So the cost function will tell you that if you produce this quantity, this will be the cost that you incur. If you produce that quantity, this will be the cost that you incur. So it's just a mathematical expression showing the relationship between the cost and the level of output, all other factors being constant. So we are going to look at short-run cost analysis and then the long-run cost analysis. So we will first of all start with the short run, right? We will first of all start with it. Now note that we said that in the short run, there is a fixed input in the short run, and there is also a variable input. So it means that we pay money for the fixed input. So the cost you incur on the fixed input is what is referred to as a fixed cost. So in the short run, you can distinguish between a fixed cost and then a variable cost. So the cost you incur on the fixed input is your fixed cost, and the cost you incur on the variable input is your variable cost, right? So therefore, there are some costs, concept or type of costs that we can derive from these two types of costs in the short run. So the first one is your total fixed cost. So this comprises of all the costs incurred on the fixed input. So that is your total fixed cost. So the cost of the fixed factors of production. And then you also have your the total variable cost. It is also all the costs incurred on your variable factors of production. Now, if you sum your fixed cost, that is your total fixed cost, and your total variable cost, that gives you your total cost of production. So if you see the last column on your right, where you have the equation, you clearly see that total cost of the firm in the short run is equal to total fixed cost plus your total variable cost. Now, in addition to total cost, we also have marginal cost. So again, by this point, we know that once marginal is mentioned, then the issue of change over change will come in. So marginal cost is the change in total cost resulting from 1 unit change or increase in output. So marginal cost is obtained as the change in total cost divided by change in Q. And then we also have our average fixed cost. So that is fixed cost per unit. So mathematically, it is obtained by dividing your total fixed cost by the quantity of output that you produce. There is also the average variable cost. It is just the variable cost per unit. So it's also obtained by dividing your total variable cost by the quantity that you produce. And then we have our average total cost, that is the total cost per unit. And that is obtained by dividing your total cost by the quantity or summing the average fixed cost and then the average variable cost. And that will give you your average total cost. So this is what the formulas that we have seen is. So this is the same thing. So to find your total fixed cost, it will be the quantities of the fixed input that you employ multiplied by the price per unit of the fixed input. Your total variable cost will be the quantity of the variable input employed multiplied by the price per unit of the variable input. And then the rest are all the same as we saw in the previous slide. So there's a table here that explains this further. So if you look at this table, the price of capital, which is the P subscript K, is the price of capital. And the price of labor is the P subscript L, is the price of labor. So the price of capital is 50, and then the price of labor is 100. So if you look at the table, you see that the quantity of capital employed is the same for all levels of labor. So that tells you that capital in this case is the fixed input. So it does not change. The quantity of capital employed does not change. It's the same for all levels of labor. And then you now see that labor changes over time, so it moves from 0 up to 10. And then we have the third column, which is measuring the total product. So that has also been provided for you. So you are told that these combinations of capital and labor would yield this level of output. So now you are asked to find or fill the other column. So your total cost or your total fixed cost will be the price per unit of capital multiplied by the units of capital employed. So you see that your total fixed cost for all levels of output is going to be 500 out. So you can do that. So for all levels of output is going to be 500. And then your total variable cost would be the price per unit of labor multiplied by the unit of labor employed at each level of output. So if the output is 0, then we don't employ any unit of labor. So your total variable cost would be 0. And then if you come here, you employ 1 unit of labor, and the price per unit of labor is 100. So it's going to be 1 times 100, which will give you 100. And then you come to 2, 2 times 100 gives you 200. 3 times 100 gives you 300. And then you can continue up to the 10th unit of labor employed. Your total cost will be the sum. So the sum of your total fixed cost and then your total variable cost. And that will give you your total cost. So you sum your total fixed cost and then your total variable cost, and that will give you your total. Somebody says I should go over. So the total fixed cost, I'm saying that it is the quantities of the fixed input employed, which is 10 throughout at each level of production, multiplied by the price per unit of the fixed input. So you are told that the firm uses 10 units of fixed input at each level of output. So you multiply 10 by 50, and that gives you what? 500, right? So it means that your fixed cost, that is the total fixed cost at each level of output, is going to be 500 throughout. So you have it 500 throughout downwards. And then so your average fixed cost at each level of output would be your total fixed cost divided by that level of output. So if you pick the first level of output, which is 0, your average fixed cost will be undefined. So you put that a dash there. Then you come to here. So you have 14 units of output, right? So your average fixed cost is going to be total fixed cost divided by the units of output. So this here divided by that will give you the average fixed cost. So divided by average fixed cost. So, and then you come to, you can do the others as well. So your average fixed cost at the output level of 35 is going to be, your total fixed cost here is 500 divided by 35. So you see that your average fixed cost will continue to decline throughout, but I'll show, or we'll see that it will never be equal to 0. It will continue to decline, but it will never be equal to 0. And then you come to your average variable cost. So it's the same concept. Is your total variable cost divided by the quantities of output that is produced, or at each level of output. And that will also give you that. And then your total average total cost will be your total cost divided by the quantities. And that will also give you the average total cost. And the marginal, again, is the difference. So by moving from 0 to 14, your total cost will move from 10 to, so you multiply this by 5, so 1, so that will be 300. So it's going to be 600. So it will move from 500 to 600. So the change is going to be 100, and then the change in output will be 14. So it's going to be 14 over 100 over 14, and that will give you the marginal cost there. So total variable cost, this is the labor units employed, and you are told that a unit of labor is 100. So if I employed 0 units of labor, my total variable cost will be 0 times 100, and that gives me 0. If I employ 1 unit of labor, my total variable cost will be 1 times 100, that will be 100. If I employ 2 units of labor, my total variable cost will be 2 times 100, that is 300, and it goes. That's how you get your total variable cost, right? That's how you get your total variable cost. And I'm saying that the marginal cost, so to obtain marginal cost, you want to find the change in total cost divided by the change in output. That gives you the marginal cost. So if we pick the first one, your total cost here will comprises of only the fixed cost, because you don't have a variable cost. So the fixed cost will be 500 here. And then when we move to the second one, where we employed 1 unit of labor, your total cost is 600. So it's going to be the fixed cost plus the 100. That gives you 600. So therefore, what is the change in total cost? The change in total cost will be 100 divided by the change in output. The change in output was 0, and it goes to 14. So it means that your marginal cost will be 100 divided by 14. That gives you the marginal cost here. I saw a hand up. I don't know if it still have. Okay, Ashon, Roger Ashon. So why do you raise your hand up when I'm about to call you? Then you lower it. Okay. So that will give you the marginal cost as well. So once you generate this, you can draw the graph of the totals and also the graph of the marginal and then the averages as well. And that's what we have in our next slides. So these are the graphs for the totals. So you have your total cost, you have your total variable cost, and then your total fixed cost, right? So let's start with the total fixed cost. What do we see? We see that total fixed cost is a horizontal line. And the reason why it's a horizontal line is because output does not change the, the total fixed cost. So the total fixed cost remains the same irrespective of the level of output. That is why you have it as a straight line. Right? So this is your total fixed cost. It remains the same irrespective of the level of output that you produce. Then we have our total variable cost, which starts from 0. So you see that if you produce 0 units of output, then you don't incur a variable cost. But as you increase the units of output, your variable cost also rises. So you see you have a rising variable cost that goes up that way. Right? So that becomes your total variable cost. And then the last one is the total cost. Now you see that the total cost line does not start from 0 because at 0 there's a fixed cost incurred by the firm. So that is why your total cost line starts from the value of the fixed cost, your total fixed cost. Because even at 0, you are still incurring the total fixed cost. Now the shape of these curves, why you have the total fixed cost being horizontal, the total variable cost and then the total cost curves being upward sloping, again is explained by the law of diminishing marginal returns, which we will come to later on. We will look at the relationship between the cost curves and then the product curves. So the shape of the cost curves is explained by the law of diminishing, or is explained by the diminishing marginal returns that we looked at in the case of production. So these are how, or this is how the curves of the total or the totals will look like. So the total fixed cost, the total variable cost, and then the total costs. Now, what about the marginal and the averages? They also look like this. Now, this is not properly drawn, but I will switch to the whiteboard to draw how we expect these curves to look like. Also, due to the law of diminishing marginal returns, or the law of diminishing returns, right? So let me just switch to the whiteboard to explain that, and then I'll end from there because my time is almost up. So I want to draw this curves, the curves for the, so I have my average total cost here. I have my average variable cost here. I have my average fixed cost here. And then I have my marginal cost. So we will see that the law of diminishing marginal returns results in a situation where the average total cost curve is U-shaped. It's going to be a U-shape. The average variable cost curve is also U-shaped. And then the marginal cost curve is also U-shaped, but it cuts the average total cost curve and then the average variable cost curve at the minimum of the two. And then of course we have our average fixed cost, which continues to fall, but will never cut the x-axis. So this is how the curves look like. So they are all U-shaped, but the marginal cost curve will be equal to the average total cost at the minimum of the average total cost. And then again, it will also be equal to the average variable cost at the minimum of the average variable cost. And then one other thing you also see is that the average variable cost reaches a minimum before the average total cost, right? So it is these curves that we'll be working with subsequently, right? Okay, any question? I think it's time for us to, so for those who have your class at 2:30, other than that, what we are left with is not much. We could have completed it, but it's fine. I mean, I'll look for time tomorrow and complete it with you. So what we are left with is to now look at the relationship between production and then the cost in the short run. So any question on this or what we have done so far before I end the class? Okay, so if you don't have any question, then I think have a good afternoon and then enjoy the rest of the day. Bye-bye. I will liaise with your class rep and then set a time for either tomorrow or Sunday to complete this lecture. So have a good afternoon. Bye.